Good afternoon, you all are welcome to the consolidation. So, with this, we can start our discussion. So, in previous semester, you may learn under the BRG the introduction to the group accounts, to the consolidation and the basic group. So, you have a parent and as a subsidiary, right? So, the introduction to the group accounts, entities will often invest in equity of other businesses. The extent of the equity shareholding will normally determine how the investment is accounted for. Whether it is a consolidation, if it is a we have control over such investee, we used to account those kind of investment by consolidation, SLFRS 10 requirements and SLFRS 3 requirements. The treatment applied for investment is intended to reflect the importance of the investment in the financial statement of the investee and how the future performance and financial position might be affected by these investments. It follows then that the greater the level of investment, more detailed the financial information will be, whether it is a joint venture, joint arrangement, or the investment in associate. A significant investment in another entity may require additional financial statement to be produced, right? Intercompany investments has become a common practice in the modern business context and used as a strategic weapon to expand and diversify the businesses in the form of simple investment. Investment in associates, the simple investment deal with SLFRS 9, the financial instruments. The investment in associate LKS 28 will be governed. Investment in subsidiaries, investment in joint ventures. The accounting treatment for these various types of investment are different to each other. That in IASB, International Accounting Standard Board, and in the context of Sri Lanka, the CA Sri Lanka has issued separate standard to address the accounting treatment under each investment. Right? You can see here group accounts consolidation in here that is involving SLFRS 3, SLFRS 10, consolidated statement of financial positions, SLFRS 11, the joint arrangement, and LKS 28, investment in associate, LKS 27, the separate financial statement, and LKS 12, SLFRS 12, the disclosure of the interest in other entities. So this chart is reflect if you have control over the investee as a shareholding, the equity shareholding is 50% greater than 50%. You want to use the acquisition method, it means you need to use the full consolidation in line with the relevant applicable accounting standard. If it is investment in associate, you are using equity accounting to account for such investment. So we assume we identify if the investment is associate if we have significant influence over the investee, right? What is meant by significant influence? You can refer LKS 28 to get a brief and idea. If the such investment is greater than 20%, we call as a investment in associate, right? The joint arrangement, joint control, 50-50. It means equal, depend on the type. If we have unanimous consent, that is a joint arrangement, joint venture. Other investment depend on the type. SLFRS 9, it can be a FVTPL instrument, if we have a through OCI, convertible hybrid instrument, those things will be there. Right. So the concept of control and investor controls and investee when it's exposed who has a return right to variable returns from an involvement with the investee and the ability to affect those returns through the power of the investee over the investee. Thus, the investor controls an investee if and only it is investor has the following power over investee, exposure or right to variable return from its involvement in the investee, right? The ability to use the power over investee to affect the amount of investors' return, right? What is mean by power? Those things is mentioned. You can see here. This is for your knowledge, not for the general idea. So you learn those things in first year, sorry, second year. I think accounting for complex group. So as previously we discussed, we have two types of group structures. It can be either a vertical group or the mixed or D-shaped group. The term complex group is used to The term complex group is used to refer situation where the parent entity has a control over subsidiary without directly owning is it, right? Instead, it owns the shares indirectly via another subsidiary. In the complex group, we have a parent, we have a parent. That parents belong a subsidiary. That subsidiary belong a it's subsidiary in from parents' perspective. This subsidiary called as a subsidiary. Subsidiary is subsidiary, right? Subsidiary, right? Right. So you can see here. In such situation, we call that third entity a subsidiary of the parent. For example, it is a situation where the ultimate parent P has a subsidiary A and H itself has a subsidiary S. S is regarded as a subsidiary of P. The parent perspective, S is a subsidiary. S is a subsidiary, right? Well, as a subsidiary of H and must therefore be line by line consideration in P's console, so financial statement. For accounting purpose, we refer S as a subsidiary of P, parent, right? So the we have vertical groups. In vertical groups, you can easily identify vertical groups. The parent, we have a parent, right? Here we have a parent. The parent holding 60% of the S. This is a subsidiary to the parent, and S owns 70% of the SS. 70% of the SS. This is a subsidiary of the parent, right? Of the P. Subsidiary, indirect subsidiary of the P, right? Under the mixed group or the D-shaped groups, we call as the this group structure like a D shape. That is why we call as a D-shaped group. Ultimate parent is the S. The parents own the investment in S, that is subsidiary. That this subsidiary own its investment in another subsidiary SS. So this SS is a subsidiary of on behalf of the parent, right? And meantime, P also hold a direct holding. P also hold the parent has a direct and indirect ownership of the subsidiary. Here this 40% is the direct investment of the SS, but here it has a 60% over its subsidiary, and subsidiary has a 50% over its subsidiary. From the parent perspective, this SS has a subsidiary, and in that case, we can recognize what is the effective holding. 40% direct and 60 into 50%. That means 60 into 50% means what? 60 into 50%. That means 30% into 40% means 70% effective interest. That the NCI is 30%, right? You can see here. So we have a test number 1. We can discuss this test number in detail with you all. So better to read this question. Right. The test number 1, P made an 75% investment of 40 million on S in 31st December 2019 with the net asset of the S were 48 million. Share capital plus the retained earnings. On 31st December 2020, S made a 60% investment of 20 million in SS when the net asset of SS were 30 million. Stated capital is 20 and retained earning is 10 million. None of these entities issued new shares since 31st December 2019. There has been no impairment of the goodwill since its acquisition. The group policy measure to NC at a proportionate net share basis. The summarized financial position is given. So you have comprehensive income, the P&L, and you have, I think, the SOFP and the consolidated changes in equity statement. Required to prepare the consolidated financial statement. So we want to firstly prepare the consolidated consolidated financial position, right? The P is made a 75% investment to acquire SS. So we want to firstly sketch a diagram. P invest 75% in S. S invest 60% in SS, right? 60% in SS. This is a what? This is a vertical group, not a D-shaped group, right? You can see here. Not a D-shaped group. This is a vertical group. 25%. Right, you can see here. I think I'm not going to repeat it. What is the effective interest in subsidiary? Effective interest. Identify the group structure. Effective interest. What is the effective interest? 75 into 60. That is 45. In the NCI is 55. How to come 55? 1 minus this. That is 55, right? If I'm go show this as a percentage, you can see here. Right. This is the subsidiary, right? Not the subsidiary. Subsidiary. Right. So nextly, we can start the consolidated SOFP, the cost of control accounts, cost of control account S. So we need to have a cost of control account SS, and we need to have again the stated capital of S, stated capital of S. Again, we need to have the stated capital of subsidiary. Again, we need to have retained earnings of the subsidiary, retained earning of subsidiary, consolidated retained earning, and finally NCI, non-controlling interest, right? Right. So we can compute the goodwill starting workings. So firstly, we want to put the opening balances. The retained earnings 60, 48, 30, 60, 48, 30, 60. Sorry, that is parent one, right? 60,000. 60,000. Here you can see 48, 30. 48,000 to subsidiary, 48,000, and again 30,000, I think, isn't it? Right, that is the opening brought forward balances. Right. So I think that is clear to you all. 48,000, 30,000, and 60,000. Right. So firstly, we want to recognize the purchase consideration, the investment in S. Investment in S. What is the investment? In order to acquire this, P made a 40 million. 40 million. 40 million investment. And we don't know the NCI. Then we can start this investment as well. Sorry, the retained earnings and the stated capital at the acquisition date. So we don't have such reserves irrespective of the retained earnings and stated capital. Stated capital is not changing. 24,000, 24,000, 24,000. So, sorry, we want to firstly put the opening balances. Stated capital, what is the opening balances here? 24, 20, 24, 20, right? 24, 20. Right. Though the first entry is stated capital, cost of control credit, stated capital account, debit, cost of control of the S, that is 24,000. Right. The retained earnings at the acquisition date, that is, it mentioned the retained earning balances, 24,000 here. You can see the retained earnings also 24,000, right? 24,000. Retained earnings 24,000. What is double entry? The cost of control credit debit to a the subsidiaries return earnings should be debit 24,000. Right? Cost of control of S. Right? I think that is clear. Same time you want to take the investment in SS. But here, keep remember you can't take the entire 20 million as your investment because you own only 75 by the parent. In that case, sorry, 75% of the subsidiary. In that case, you can recognize such subsidiaries investment for made for the subsidiary up to your holding percentage of the subsidiary. It means for 75%, right? 20,000 into 75%, that is 15 million, 15 million, 15,000, right? 15,000 since we are using thousands, 15,000. And remaining 5,000 goes to the NCI because we own only 75 of the subsidiary. Then remaining 25 goes to the NCI, right? NCI. Investment of SS, it is 20,000 into 0.25, 5,000. I think that is clear. Then you can recognize the stated capital. Stated capital is 20,000 and retained earnings 10,000. Stated capital is 20,000. And recognize the cost of control credit and the retained earnings should be, sorry, stated capital is should be debit, right? Right, right. The retained earning balances, retained earning balances here it's given 10,000. You can recognize 10,000. Retained earnings debit, cost of control credit, retained earnings subsidiary 10,000, right? Right, that is done. Then you want to take the NCI because this since we are not using fair value method, we are proportionate net share basis. Here you can take the proportionate net share. What is the proportionate net share? Yes. This into what is the NCI percentage? 0.25, right? That is 12,000. 12,000 cost of control debit credit to NCI account, right? Cost of control S. That is 12,000. Right? Right. Here you can again you can use the NCI plus this into what the percentage 0.55 because the effective interest is 45%, remaining is the 55%, right? 16,500 you can see here. That is cost of control debit credit to a NCI account. Cost of control of SS is 16,500, right? That is clear. That is clear, right? Right. Then we don't have such adjustment, so we can distribute the. So this account is netted off. That is netted off, and this also netted off. You can see this also netted off, and here you can take the goodwill. You can take the goodwill. What is the goodwill amount? Goodwill. You can take here. Goodwill is 4,000. Here the goodwill is 4,000, and here you can see again. What is the goodwill? Goodwill is 1,500, right? You can see here. Right, this also netted off that, but this subsidiaries return earning should be distributed among the parent, the consolidated return earning, and the NCI. How to distribute this? This minus the what is this, Sunny? The pre-acquisition profit into 75%. I think parent holding 75% of the subsidiary, right? Isn't it? Yeah, 75%. That remaining balance 6,000 goes to the NCI, remaining 25%, right? Right. Then this account is tallied, netted off. You can see here, netted off. Right. Then we want to do the adjustments. The consolidated return earning debit, return earnings of subsidiary. What is the amount? 18,000. And the NCI account need to be credit, return earning of subsidiary. What is the amount? Amount of 6,000. Then you can see this account also netted off. Then you want to hear same thing, consolidated return earning. What is the amount? What is the amount? Into what is the effective holding of 45%, right? 45%, 9,000. And the remaining 55% goes to the NCI. It means 11,000, isn't it? See also that this account is now netted off. This account also done. So we can see here the consolidated return earning of subsidiary SS. What is the amount? 9,000. And the NCI account, the return earning of SS subsidiary, it is 11,000. Right. So once we get the summation of this account, we can see 87,000 is this amount. Carried out balance also 87,000. Right. Right. Here you can see here closing balance. Sorry. Now we going to prepare the consolidated statement of financial position, right? Now we can see I'm preparing here console SOFP, the non-current assets. If it is, what is the amount? 60, 40, 40. 60,000, 40,000, 40,000, right? That is 140,000. Right. Non-current assets. Then we have investment in subsidiaries. No, do not bother. So we have goodwill arising from business combination. What is the goodwill amount? 4,000 plus 1,500. It is 5,500. Right, goodwill. Then again we have net assets 20, 12, 10. 20,000, 12,000, and 10,000. net asset, current assets. Then altogether we have total asset amount of 187,500. Right. This is the total assets. We can call this as a total assets, right? Mm, right. Then we have equity and liabilities. Equity and liabilities. What is the amount? The stated capital, the parent portion. Stated capital is how much? The parent amount, that is 60,000. Consolidated return earning. What is the amount? Consolidated return earning. What is the amount? Consolidated return earning 87,000. And the NCI shareholders interest. NCI shareholders interest 40,500. 40,500. And then we do not have any adjustments. So we can take the summation of these things. Then it is balancing. You can see here it is balancing. Balancing. Total equity and not that, right? And liabilities. Right. That is done. Mm, that is over. Now we need to prepare the VR consolidated SOFP, correct? The consolidated income statement, the P&L and the OCI. So that is easy. Then you can leisurely compute that one, and thank you all.